Sarah got the call on a Tuesday morning. She had spent 2 years saving, 2 years eating out less, skipping vacations, turning down friends. She had $40,000 ready for a down payment on the home she had always wanted. And then the mortgage broker said something that made her stomach drop. Your interest rate is going to be 7.1%. 7.1%. On a $320,000 home, that meant she would pay back nearly $500,000 by the time it was all said and done. Over $180,000 of that was pure interest. Not the house, not the equity, just the bank's cut, because of a 3-digit number. But here's what the broker didn't tell her. Here's what no one in that office was going to volunteer. Sarah's situation wasn't permanent. In fact, within the next few months, everything was about to change. And it wasn't because of luck. It wasn't because her income shot up. It was because of something buried deep inside the credit system that banks understand perfectly and consumers almost never do. Welcome to WealthSimplify, where we make money simple enough for anyone to understand. Stick around and watch this whole video because if you skip even one part, you will miss something important. While you are here, consider subscribing and giving this video a like. It tells the YouTube algorithm that you are serious about improving your money, and YouTube will start showing you more relevant content like this video that actually helps you succeed. You found this video for a reason, so make it count. Now, I want to talk to you about the credit score game, because that is exactly what it is, a game. And most people are playing it without ever reading the rulebook. You have probably heard the standard advice. Pay your bills on time, don't carry too much debt, don't open too many accounts, be patient, be responsible, and eventually, over many, many years, your score will slowly climb. That advice is not wrong, but it is dangerously incomplete. And the part they leave out? It's the part that cost you the most money. Think about it this way. Imagine two people buying the exact same car. Same year, same model, same price. One person walks out paying $4,000 in interest over 5 years. The other person pays $9,000. Same car, same purchase. The only difference? Their credit score. That gap, that $5,000 gap, is what we call the credit score tax. And it shows up on mortgages, car loans, credit cards, and even your insurance premiums in many places. The conventional path keeps people paying that tax for years longer than they have to, and the financial industry has very little motivation to fix that. So let's talk about the people who figured out a better way. Sarah's credit score sat at 618. Not catastrophic, but not good. She had a couple of credit cards, a student loan, and a history that was only about 3 years old. She just hadn't had enough time to build anything substantial. After hearing that 7.1% rate, she called her brother Marcus. Marcus had been obsessing over personal finance for years and had stumbled onto something most people never learn. He asked her one question. Does Mom still have that Visa card she opened in 1998? Sarah paused. Yeah, she did. Their mother had a credit card that was over 25 years old. Perfect payment history, low balance, never missed a payment. Marcus told her to ask Mom to add her as an authorized user. Sarah didn't fully understand what that meant. She thought it was about borrowing money or piggybacking on debt. Marcus explained it had nothing to do with that. She wouldn't even need a physical card. Here's what was actually happening beneath the surface. When you become an authorized user on someone else's credit account, that account's entire history gets copied onto your credit report. The age of the account, the payment record, the available credit. All of it appears as if you had been part of that account from day one. Let that sink in for a second. Sarah's oldest account was 3 years old. Her mother's card was 25. The moment her mom added her as an authorized user, a 25-year-old account with a spotless record appeared on Sarah's credit file. Her average account age jumped dramatically. Her available credit nearly tripled. Her credit profile went from looking like a college student's to looking like someone who had been quietly, responsibly managing credit for decades. Within 2 billing cycles, roughly 60 days, the change hit her reports. Her score climbed from 618 to 742. 124 points in 2 months. The mortgage broker called to confirm it was the right Social Security number. Same person, same income, same job, different knowledge. And here's the important part. This is not a loophole in the illegal sense. The authorized user system was built into credit scoring intentionally. It originally existed so that one spouse could share decades of credit history with a partner who had stayed out of the workforce. Over time, people realized it worked for anyone willing to share: a parent and child, a close friend, a trusted family member. The credit bureaus never changed it because it reflects a genuine financial relationship. Banks know this exists. Credit repair companies charge hundreds of dollars to explain it. Financial advisors who work in this space use it for their wealthiest clients first. The average consumer almost never finds out. Now, let's talk about Marcus for a second, because he wasn't just helping his sister. He was also working on his own situation. Marcus had a decent score, around 680, but his utilization was quietly dragging him down. He was using about $2,800 out of $4,000 in available credit each month. That's 70% utilization, way too high. But here's the trap Marcus fell into for years. He paid his bill in full every single month, never paid a dollar in interest, thought he was doing everything right, but he was still being penalized. Why? Because your utilization isn't measured when you pay your bill. It's measured when your statement closes. So even though Marcus was paying everything off, the balance on his statement was showing up on his credit report as 70% utilization, and his score was taking the hit every single month without him knowing. The fix was simple once he understood it. He started making a payment a few days before his statement closing date. Instead of a $2,800 balance being reported, he was now showing $100 or less. His utilization dropped below 3%. His score jumped 35 points in a single billing cycle. Not a year, one cycle. And then he called his credit card companies and asked for limit increases. American Express bumped his limit without even doing a hard inquiry. Doubling his limit cut his utilization ratio in half, even before he changed his payment habits. It was the denominator doing the work instead of just the numerator. So let's zoom out for a second and talk about why this matters so much. A 680 credit score and a 760 credit score might sound close. They're not. They live in completely different interest rate neighborhoods. On a $300,000 mortgage over 30 years, that difference can be worth over $150,000 in total interest paid. That's not a rounding error. That's a retirement account. That's a college fund. That's a decade of vacations or a paid-off car or a financial cushion that lets you take risks that actually move your life forward. The credit score tax is one of the quietest wealth destroyers in existence because it doesn't feel like a loss. It just feels like your normal bill. You don't see what someone with a better score is paying. You just pay yours and assume that's how it works. But it's not how it has to work. So here's what to actually do, depending on where you're starting from. If your score is below 650, the authorized user strategy is your biggest lever. Look for a family member or very close friend with an account that is old, ideally 10 years or more, with a perfect payment history and low balances. Ask them to add you. They don't need to give you a card or access to their account. Most major card issuers like Chase, American Express, Bank of America, and Discover report authorized users to all three bureaus. Within 1 to 2 billing cycles, that history becomes yours. If you're between 650 and 720, you're in fine-tuning territory. Request credit limit increases across your existing cards. Do it every 6 to 12 months. Most issuers will approve increases with no hard inquiry if you ask properly. Then tackle your utilization timing. Start paying before your statement closes, not just before your due date. These two moves together can push a 680 to a 730 or higher without opening a single new account. If you're already above 720, you're in good shape, but don't stop. The gap between 740 and 780 still matters for the best mortgage rates. Keep your utilization under 5%, let your oldest accounts age, and avoid unnecessary hard inquiries. And regardless of where you are, pull your free credit reports from all three bureaus. Studies consistently show a significant percentage of reports contain errors. Errors that could be dragging your score down for something that was never even your fault. Disputing those is entirely separate from everything we just talked about, and it costs nothing. One more thing worth knowing. If you are actively applying for a mortgage, ask your lender about rapid rescoring. It's a process where your lender can submit documentation of recent changes, a paid-off balance, a new authorized user account, and have your score updated within days instead of weeks. Most consumers don't know it exists. It's only available through a lender during an active application. But if you time your credit moves right, it can change your rate before the loan closes. Sarah closed on her home at 5.6% instead of 7.1%. Over the life of that loan, she will pay approximately $178,000 less in interest because her mom took 10 minutes to log into a website and add her name to an account. That's the reality of financial literacy. It's not about working harder or earning more. Sometimes it's simply about knowing which doors exist and having the courage to walk through them. The credit system was not built for you. It was built by lenders, for lenders. But the rules are public. They are mechanical. And once you understand how the machine actually works, you stop being its victim and start being its user. You don't have to wait years to have excellent credit. You just have to know what excellent credit actually responds to. Now you do! If this video helped you, share it with someone who's about to take out a loan, buy a car, or sign a mortgage. Because the difference between knowing this and not knowing it is measured in thousands of dollars. And it's always the people who need that money most who are least likely to find out on their own. Subscribe to WealthSimplify. We will keep breaking it down until money stops being confusing and starts working for you. I will see you in the next one.